cursor blinks over the entry field like a heartbeat. 5-minute candlesticks breathe in and out on your trading view screen, while level 2 prints flicker between bids stacked at support and a thin offer 2 ticks above your planned entry. Your stop loss is pre-typed but not armed. Your finger hovers, tracking the wick as it probes yesterday's VWAP and pulls back. News just dropped. A micro spike snapped 3 points, then snapped back harder. Your brain whispers, wait for one more candle. Your edge says the setup is here. Higher low into reclaim, rising cumulative delta, sellers exhausting. You feel the cortisol nip as the P&L simulator shows what could have been if you had clicked 2 seconds earlier, and the dopamine promise of green flashes in your imagination. Another buyer lifts the offer. The footprint chart shows absorption starting to thin. The risk-reward is still 3-1 if you take it now and if you respect your stop. The double. If is the entire game because the moment you click, probability replaces fantasy. Quick reminder woven into this breath. This is education, not personal advice. Most traders lose money. Past patterns don't guarantee the future. Risk management is survival, not a guarantee of profit. You exhale and the market doesn't care. It never did. It only asks if you can execute precisely when it feels worst. You've been told 1,000 times that high probability entries are about waiting. But the hidden cost of waiting is how your belief system morphs between candles. Mark Douglas called it the shift from uncertainty to certainty illusions. As a bar forms, your mind invents meaning and then attaches self-worth to that meaning. That's why the green spike on the 1-minute chart feels like proof that you knew it, even if you never pressed the button. In The Disciplined Trader, he framed it bluntly. The market has no rules for you. You must impose them, or your beliefs will impose themselves in the form of fear and hope. Trading in the zone extends the idea. Each trade is a unique event, a roll of loaded dice whose load is your edge, not your emotion. But your brain isn't wired for dice. It's wired for stories, especially the story where the next candle validates the identity you prefer. Brett Steenbarger's performance lens adds a surgical detail. Your self-talk flips your focus from market information to self-evaluation at exactly the moment you need bandwidth for pattern recognition. When your inner monologue says, "Don't lose," it drags your gaze from order flow to your imagined P&L, and you literally perceive less of the tape. The neuroscience sits under your mouse hand. Green unrealized P&L triggers a dopamine spike novelty plus reward prediction error, which makes holding winners harder because your brain wants to lock in the candy, not run a statistically valid plan. Red unrealized P&L spikes cortisol and adrenaline, shifting your vision to tunnel mode. You stop noticing the second test of VWAP or the hidden buyer in the book because your body is screaming, "Get out or fight." The paradox? The best entries and the best holds often feel most uncomfortable. That discomfort is not a signal of bad probability, it's the somatic experience of uncertainty. The more you chase comfort, the more you degrade probability. Loss aversion and social proof. Two pillars of behavioral finance that Trading Psychology 2.0 calls out relentlessly whisper that your high probability setup is only valid if chat, X, and your Discord agree right now. That's how chart pattern hallucinations happen. The longer you hesitate, the more your brain sees confirmation in random squiggles. Meanwhile, professional traders from Market Wizards repeat a boring mantra. Execute the same playbook the same way across timeframes, size relative to risk, and let stops be the truth. Pros don't need the crowd to confirm. They let their risk define the trade. Notice how your entry paralysis is really a belief conflict. Part of you believes, I only click when I'm sure. Another part knows, there is no sure. If your internal contract says, no pain is acceptable, your hand will wait for the candle that feels painless. And those are precisely the candles with the worst asymmetry. The paradox compounds at exits. When the market hands you open profit, your dopamine says, take it now so it doesn't hurt later. While your edge says, trail behind structure, and let the trade pay for the next 9 losers. More analysis can perversely lead to worse results, because analysis morphs into bargaining. You add a second RSI, a third moving average, a fourth time frame, convincing yourself you're being rigorous, but what you're doing is building an escape hatch from uncertainty. The way to trade reminds us, systematic rules remove the burden of bargaining. They turn "should I" into "I will when X and I won't when Y." When your rules are mechanical, your belief conflict shrinks because there's nothing left to negotiate. Now the costly pattern, you wait for the perfect engulfing candle to confirm your bias, then enter 3 ticks late with a tight stop that sits exactly where the auction probes for liquidity. You get tagged out by a 1-tick wick, watch price rip to your original target, and then because serotonin just dipped and your self-image took a bruise, you enter impulsively, bigger, to get your money back. That's revenge trading, and it flips probability on its head. Your entry is now based on emotional relief, not asymmetry. Or you catch the move early, but as soon as your unrealized P&L flashes green, the dopamine itch says, bank it. So you cut the winner at 1R, even though the risk map supported 3R. Then a losing streak hits. You tighten stops to protect capital, which in a choppy open turns your stop into a magnet. Tighter stops equal bigger losses because you're getting shaken out more often and then re-entering worse. You end the week exhausted, overtraded, underpaid. The loop feeds itself. Fear of pain creates behaviors that produce more pain. Most traders lose money not because they can't read a chart, but because they don't know how to read their nervous system in real time and put it inside a rules engine that's stronger than their next heartbeat. Meet Marcus, today's risk manager. 2 27-inch screens show trading view with a clean price action layout, footprints, and a volume profile. A side panel runs level 2 and order flow. A narrow third monitor hosts his journal and a small checklist app. He trades the first 90 minutes and the last 60 of the cash session. His plays are high probability only by his definition. Narrow risk, clear invalidation, auction context, and a minimum 3-to-1 map visible on the chart before he clicks. He sizes by R, not by feeling. Fixed fractional risk, dynamically reduced after 3 consecutive losers, restored only after 2 winners. He pre-writes the entry sentence for each setup. If we reclaim VWAP with cumulative delta ticking up and absorption fading at the offer, long with stop 2 ticks below the reclaim candle's low. When the sentence is true, he places the order. When it's false, he doesn't explain, he doesn't argue, he doesn't chase. He has 2 exits, structure-based partial at 2R and a trail that follows swing lows chucked highs on his execution timeframe. He never moves the initial stop away. He allows adding only if risk stays constant and structure supports. Ads are pre-planned, not improvised. Watch him in a live sequence. The open gaps down into prior day's value. The initial drive sells, then stalls at a composite, high-volume node. Marcus marks the LVN above as his line in the sand. He narrates softly, not to hype, but to anchor attention on process. If bid flips back above LVN with buyers sustaining, I want the reclaim. The tape flutters, a fake break lower, then aggressive lifting. His checklist beeps, pattern present, context valid, spread acceptable, news quiet, risk map drawn. The system trader in him, borrowed from the way to trade, executes without asking for comfort. His dopamine spikes as price goes green. He smiles because he recognizes the hit. He names it out loud to diffuse it. Reward signal, not exit signal. At 2R, he takes a partial per plan. The rest trails below the last higher low. A red candle prints hard. Adrenaline rises. His hand twitches toward flattening. He inhales, checks the trail, and does nothing because his rule is to do nothing while breath is shallow. The next candle reclaims, his heart rate drops. The trade hits the final target near the prior day's developing POC. He's out. He writes 3 notes. What he saw, what he felt, how he behaved, each in 1 sentence. If the same setup fails, he writes the same 3 notes. Belief conflicts don't vanish. He audits them. Marcus's edge isn't a magical signal. It's stacking probabilities under conditions that don't tolerate self-betrayal. He holds the Douglas probability mindset. Any trade can lose. The next trade has no memory. The only constant is risk. He uses Steenbarger's performance tools. When anxiety surges, he steps away for 90 seconds to reset state. When boredom threatens, He reduces size rather than manufacture trades. He respects the paradoxes. He knows that when a setup feels perfectly safe, someone else is about to sell him their risk. When it feels nasty, it might be early, which is where the R lives. He doesn't worship indicators. He reads the auction and volume profile, honouring the idea that price is an ongoing negotiation, not a destiny. He learns from market wizards the unromantic truth. There is no freedom without rules, there is no consistency without boredom, there is no longevity without humility. So how do you rewire like Marcus? Start with a pre-market routine that sets your nervous system before it sets your lines. 5 minutes of diaphragmatic breathing. Eyes soft on a distant point. Exhale twice as long as inhale to bias parasympathetic tone. Then write your today card in 40 words or less. I will take A and B only. I will risk 0.5 R each. I will wait for the sentence to be true. I will not move stops away. I will walk after a loss. That micro contract beats a page of wishes. Next, codify entries into if-then statements tied to observable market structure. If opening drive fails at HVN and we reclaim with high or low, then enter long, stop at invalidation, target at prior LVN and prior day's VWAP. The moment you can't complete the sentence with live data, you don't have a trade, you have a hope. Now build a stop-loss discipline ladder. Rung 1, mechanical stops placed at entry, never widened. Rung 2, a no-touch in pain rule. If heart rate spikes, you may flatten, but you may not widen. Rung 3, a time-based fail-safe. If you're stopped twice in a single idea within 30 minutes, you stand down for 30 minutes. Rung 4, after 3 consecutive losing trades, you auto-cut size by half. You only restore after 2 winners following the plan. This converts cortisol storms into small weather, not hurricanes. Add the 2-gate rule for exits. Gate 1 is structure. Has structure broken? If yes, exit. If no, ask gate 2. Is there a scheduled catalyst or volatility expansion that changes risk asymmetry within the next 5 minutes? If yes, scale. If no, hold. The 2-gate prevents your dopamine from impersonating a plan. Journal like a trader, not a novelist. Use a 3-line template per trade. 1. Market. What the auction did at your entry and exit. 2. Mind. One feeling you noticed. 83. Method. 1 behavior you executed or violated. Tag each trade with one of the 6 behavioral biases. Entry hesitation paralysis. Exit greed extension. Stop loss removal syndrome. Revenge trading loops. Overtrading compulsion. Chart pattern hallucination. Then tag 1 neuroscience state. Dopamine chase. Cortisol spike. Adrenaline surge. Serotonin dip. Mirror neuron mimicry. Patterns will surface in a week if you tell the truth. When you see that your exit greed extension happens whenever you're up exactly 1 hour on a morning trade after a prior day's drawdown, you can install a rule. No partials until 2 hour in that scenario. Or auto-reduce size so the temptation is smaller than the rule. Running a systematic checklist does not make you robotic. It makes you free. The way to trade ethics says, let the system be the edge. Combine that with trading psychology. 2.0's behavioral awareness. Set pre-commitments to block loss. Averse hacks like just 1 more scalp after a winner. Use if-then alerts, not alarms. For example, if bid at LVN holds through 2 tests while delta rises, then alert. If alert triggers during a macro headline window, then ignore. That keeps social proof out of your execution window. Also practice the mentally trade to failure drill from performance coaching. In replay, run your setup 10 times at double speed, taking every valid signal, and hold through your trailing rules. The first time your body shouts, "get out," while rules say "stay," you narrate the sensation and continue. This said principle-specific adaptation to imposed demands trains your nervous system to tolerate the discomfort that hides your R multiples. Finally, design a daily walkaway protocol. When a stop-loss prints, stand up, literally walk to the door, touch the frame, name the loss in R, and name the next valid scenario aloud. If you can't name the scenario, you can't trade it. If you feel the urge to win back now, you shrink size to the minimum tick value for the next trade, or you skip the next trade by rule. This is how the reformed gambler archetype becomes a risk manager, not by willpower in the moment, but by making it impossible to do dumb things at full size. Remember the market wizard's pattern. Longevity is a function of how small you trade after pain, not how big you trade after confidence. Picture yourself in 3 months. The open is noisy. You've already decided you'll likely pass the first 5 minutes because spreads are sloppy. You sip, you breathe, you watch the auction. Your setup appears not pretty, not perfect, but textbook by your sentence. You click once, your stop is in. The tape tests your level. Your body tightens, the trail remains. 2 candles later, you partial without debate and move the stop to structure. Not to break even merely because that feels nice. The move extends, you feel the dopamine candy, and grin because it no longer owns your hand. A reversal snaps, your trail takes you out. You log 3 lines, you tag the bias you avoided, stop loss removal syndrome circumvented. You miss 2 later trades because the sentence wasn't true. You don't compensate with a market order based on FOMO candlesticks. Into the close, you catch a second reclaim for 1 hour and stop the day there, though the siren sings to keep clicking. Your equity curve is no longer a cardiogram of your mood. It's a staircase with normal drawdowns and occasional leaps. You're calm during volatility because calm is now a protocol, not a mood. You accept losses because acceptance is a rule, not a virtue. Your entries happen where asymmetry lives. Your exits honor structure and time, and your stop losses are not suggestions, they're your identity. This is not financial advice. This is a picture of process. The market still doesn't care, but your plan does. And now finally you do too.